European banks just continue to stand out as one of the cheapest sectors in the market, despite being one of the few, ex-commodities and tech that has actually seen strong positive earnings revisions year to date. Every time I give one of these updates, I seem to reference the backdrop as volatile or complex. But look, it's really hard to describe the first half of 2026 any differently, with the Iran war leaving macro question marks and the AI debate driving sharp share price moves across the market. As ever, that environment brings challenges, but it also opens up really ripe risk-reward opportunities for the active manager. First, if we look at Europe, the banks derated by around 15% at the trough in March post the outbreak of the war, but they have since recovered. And the fundamental picture remains really solid. You have the recent ECB rate hike that provides an incremental boost to margins. Volume growth has actually continued to slowly accelerate despite the macro uncertainty, and asset quality trends remain really benign. So, this really underpins the mid-teen ROTE picture and the 7 to 8% distribution yields. And that means also that European banks just continue to stand out as one of the cheapest sectors in the market, despite being one of the few, ex-commodities and tech that has actually seen strong positive earnings revisions year to date. Secondly, on the AI theme, look, there are always exceptions, but to generalize, we would see financials definitely as more winners than losers from AI. They are typically, data process heavy institutions that can benefit from automation. And on the other side, where trust and complexity remain, important barriers to entry and moats against easy disintermediation. The early start of the year saw some extreme share price moves. Fear was stalking the market over the sustainability of certain business models across exchanges, platforms, wealth managers, and it was no less clear-cut than in the US bank tech space. So these are companies that provide modern core banking platforms for traditional banks who do not have the scale or the capability to build it themselves in-house. But because these bank tech names fall within the software bucket, they were caught up in aggressive passive outflows that drove sell-offs in excess of 30%. But in our view, where the fundamentals remain very strong, we've got double-digit revenue growth, and it's a sector where AI should only add to the demand for their expertise. Finally, in Asia, Ryan Fu joined the investment team at the end of last year. He's based in our Singapore office, and having him on board and on the ground in Asia, really strengthens our capabilities. In Asia, look, we don't think the wealth theme is going away. And with the likes of the Japanese government seeking to increase investment participation, and if we look at equity allocation as a share of household financial assets, still relatively low in China as well, it creates what we think is long-term structural tailwinds for brokers, wealth managers, and capital markets activity. So as you can see, despite the complex backdrop, I think the global financials universe continues to offer up compelling bottom-up opportunities.